As those prices soar with U.S. crude topping 75 a barrel, what's next? Should consumers worry that high prices are here to stay, if only for a little while? Let's bring in IHS Markit's Dan Yergin, also a CNBC global energy analyst, author of the new map, Energy, Security, and the Clash of Nations. Dan, it is always great to see you. I think you heard what Brian just said there. What do you look at as the changes over the second half on the supply side and the demand side for oil?
I think, Tyler, what Brian was describing was the deal at about 400,000 barrels a day per month raise, but they are continuing to follow the market rather than lead the market. And I think what's going on now, and the reason for the postponement that Brian talked about, is they're arguing about what baselines to work at. In other words, they're talking about who gets what market share. But overall, as those numbers tell us with the price, oil's at a boil.
Yeah, oil's at a boil and likely to stay that way. Is the reason as simple as the recovery in the United States and much of Europe and the developing world, the recovery from the pandemic and the spurt of economic growth that has followed it?
Yes, I think we are now in what we started to call the post-COVID economic recovery. We're seeing what the post-COVID economy looks like. Mm-hmm. Look at air travel, what's happening. I just heard that the CBO has said 7.4% for the U.S. I'm reassured because that's the number we had 3 weeks ago. And we have the world economy recovering at 6%, although we know that the virus hangs over it. But between February and August, oil demand is going up 8.2 million barrels a day.
Dan, it's Kelly, and I just want to ask a question that follows up on a point we were making with our investor guest last hour. His sort of thesis is that oil is going to be at 80 or 90 for the rest of the year because OPEC has no reason to try and lower the price to stop U.S. from gaining market share because U.S. firms like Exxon aren't necessarily trying to gain market share, maybe because of ESG influences.
Add to that.
Yeah, go ahead.
Well, I was going to say, add to that, Kelly, that also you have capital discipline on the part of the shale producers who are going to, we're going to see a minor increase of maybe 300,000 barrels a day in U.S. production. So I think that the countries, the OPEC Plus, have gotten more comfortable that they don't have to worry about losing market share, let's say to the United States or to companies investing. I think the Russians are more sensitive and worried about higher prices and the stimulus it would provide to the United States. Also, there's going to be a pushback, and you're already hearing it. Keep an eye on the Indian Minister Pradhan, because India is a very important market for Saudi Arabia and for Abu Dhabi. 85% of their oil is imported, and they're paying already equivalent to $5 a gallon. So that's a political problem. So there'll be pressures. But I think if they continue to the OPEC Plus to kind of follow the market, then it is going to be a tight market, at least for the next several months.
Wow, and that's fascinating. I did not realize that about the situation in India as well.
Shepard Smith here. Thanks for watching CNBC on YouTube.